Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to another episode of our InvesTips podcast. Today we're exploring carbon markets, a rapidly growing space. Joining me is Eugenia Koh, Global Head of Sustainable Investing at Standard Chartered, and Lucy Palairet, Director in our Carbon Markets Development team. Thank you both for joining us. Now, maybe let's get started. So we know that carbon markets reached their peak in terms of traded volumes and market value between 2021 and 2023. The momentum was driven by ambitious climate targets and both governmental and corporate commitments. Lucy, maybe you could start walking us through some of the basics of carbon markets and how they work.
Sure, Steve, and thanks for having me on the podcast. So although carbon markets are catching the attention of modern investors, they are hardly a new concept. Carbon markets are essential for putting a price on carbon emissions and to meet global net zero. From the outset, it's just really important to know that there are two very different and very distinct types of carbon markets. You have your compliance markets and you have your project-based markets, commonly referred to as the voluntary carbon market. So I'll start quick overview of what is a compliance carbon market. So these are sort of, as they say on the tin, these are regulated and enforced by governments and consist of allowance-based mechanisms or a more simple carbon tax. So probably the most famous, if that's the right word, compliance market is the EU Emissions Trading Scheme, or the EU ETS. So under the EU ETS, this was the world's first cap and trade scheme. Entities caught under the EU ETS must ensure that their annual emissions are covered by the equivalent number of allowances. One allowance is equal to 1 tonne of CO2 equivalent and is effectively a permit to pollute. The EU issues a predefined quantity or cap of allowances, which declines every year, and entities can then trade these allowances based on their requirements to ensure they are compliant with the scheme on an annual basis. The EU enforces this scheme very rigorously, and there are quite large penalties for non-compliance. On the other hand, you have sort of a carbon tax, much simpler scheme, and effectively involves entities paying a central authority a predetermined fixed fee for each tonne of CO2 equivalent emitted on an annual basis. This is the case in Singapore, for example. In some tax schemes, some project-based carbon credits can be used for a certain volume of emissions in lieu of paying the tax, for example, in Singapore, Colombia, and South Africa. But it's just always very important to remember to note that these government-driven schemes, and as such, there are very, very rigorous checks and balances in place to ensure that emissions are properly monitored, reported, and verified, not only by the participants, but also by independent third parties.
Okay, so thanks for that overview, Lucy. Eugenia, maybe can you share more about project-based carbon markets?
Yes, sure. So project-based carbon markets are mechanisms whereby technology or nature-based projects avoid, reduce, or remove carbon dioxide, measured against a business-as-usual baseline, and are issued with carbon credits depending on their performance against the baseline. So 1 carbon credit is equals to 1 tonne of carbon dioxide equivalent avoided, reduced, or removed. Carbon crediting standards such as Verra and Gold Standard set out the methodologies and the criteria required for verifying and certifying carbon credits. These carbon credits can have a multitude of demand use cases. Lucy mentioned the carbon tax in Singapore. So in Singapore, for example, 5% of an entity's exposure to the carbon tax can be covered by purchasing specific high-quality carbon credits determined by the Singapore government. Carbon credits can also be used by private investors, governments, non-governmental organizations, and businesses to meet their own climate action targets. Paying for carbon credits provides finance for carbon dioxide mitigation projects that would not get it otherwise. Here, the concept of additionality is an important one, as a project's emissions reduction or removals need to be real and occurring only because of the project in the first place. For example, a tree planting project is additional if the trees would not have been planted without the carbon credit revenue, while a large solar farm that is already viable financially without carbon credits is generally considered non-additional. It is important to note that carbon credits can be traded multiple times between entities, but once the credit is retired and effectively removed from circulation, that the retiring entity can make any environmental claims against that credit.
Okay, so you mentioned that carbon markets are catching the attention of modern investors. Can you give us an example of some of the latest trends shaping this space?
Yeah, sure. So it makes much more sense when we try to understand the market undercurrents in the context of recent developments. You may have noticed that there is growing interest, largely because companies around the world are committing to net zero goals. There are regulatory, strategic, and financial reasons driving the shift. Right now, about 55 countries and 44 regions have some form of carbon pricing in place. What's exciting is that emerging economies like India, Indonesia, and Vietnam are also stepping up and building their own emissions trading systems. However, carbon markets work across countries. They aren't immune to cross border uncertainty. To mitigate this issue, the Multilateral Investment Guarantee Agency now offers special insurance that covers geopolitical risks. This means that you have insurance when, say, a new law makes a project impossible. Such guarantees are attracting more people to invest in international carbon projects, giving climate solutions a much needed boost. And lastly, emerging markets are likely to see strong growth with new launches or strategic expansion of emission trading systems.
Okay, so I guess it's an asset class that's becoming safer with strong growth prospects. I mean, compliance markets saw a massive expansion last year, but I think there was a dip in project-based carbon markets. So, Lucy, what do you think are the reasons for investors to consider carbon markets today?
Thanks, Steve. Yeah, so as you mentioned, it is really quickly becoming a key asset class, playing a bigger role in how funds are mobilized across the global financial system. And with the way it's scaling, getting in early could be a smart move as this market continues to mature. Coming back to your question on what's really driving the momentum right now, there's the few key regulations that are coming into play on more of an international level, which is then affecting the domestic carbon scheme. So the main regulation coming into play is what we call CBAM, or the Carbon Border Adjustment Mechanism, which is coming out of the EU and is coming into full force as of 2026. We're currently in just a reporting period only at the moment. And this is effectively the EU putting a price on carbon coming into the EU. So importers will now have to buy CBAM certificates to reflect the carbon emissions of their imported goods. And this will be linked to the EU ETS price. So this setup creates a single efficient carbon pricing rule for cross-border trade. But what it's actually really doing is encouraging other countries to put similar or to put domestic carbon policies in place, whether that's in India or China or Brazil. So we're really starting to see the effect of CBAM in these bigger importing countries or exporting countries scaling up their compliance schemes, whether that's through an emissions trading scheme or a carbon tax. So next year we'll see new compliance markets launching, especially in India. And also more than 11 jurisdictions will have emissions trading scheme frameworks under development, and 9 others are considering as well. So we're really seeing CBAM starting to have that global effect. The other big regulation coming in is CORSIA. So this is the Carbon Offsetting and Reduction Scheme for International Aviation. This is a compliance scheme specifically designed for airlines by ICAO, or the International Civil Aviation Organization. And CORSIA works by requiring airlines to purchase specific project-based carbon credits for emissions over and above their given baseline based on 2019 emission levels. The scheme is currently in phase 1, so that's 2024 to 2026, and it's not mandatory. However, over 120 countries have signed up to this phase. The current demand forecast for CORSIA eligible carbon credits in phase 1 is estimated to be anywhere between 210 to 230 million tonnes. Currently, there's very, very limited supply to meet this demand, but it's, the demand is there and the supply needs to catch up. And back to Eugenia's point as well, another source of demand really is coming from governments. We're seeing increasingly governments are entering into the carbon credit market as buyers as they look to meet their national climate targets. So we really expect carbon markets to feature among their strategies as a complement to local decarbonisation actions to achieve the net zero emissions targets.
Okay, so I think we've whetted the appetite of many people. Obviously in this environment, markets look a little bit frothy. We still think there's somewhere to go, but um, I guess people are looking for ways to diversify their portfolio. So, Eugenia, could you sort of walk through some of the ways to get started in investing in this non-correlated asset class?
Yeah, for sure. So the right investment approach is very important in carbon markets. It acts as a compass, guiding our wealth towards purpose and long-term success. Listeners can consider a couple of options. There are carbon market ETFs, which are built on compliance markets, and they revolve around trading carbon credits or allowances. There are outcome bonds, which are tied to specific projects with clear goals. Often here, though, they do have a lock-in and may lack liquidity, so they're perfect for more impact-focused investors. You do see also some carbon-themed structured notes linking their underlying assets to carbon ETF. And you do have some private equity funds like broader forestry funds, which could include carbon markets as a theme. A dedicated carbon market private equity fund does not yet exist, so it might be in the works over the medium term. And investors can also directly invest in companies that trade carbon credits or run carbon projects. Just keep in mind, though, that this route tends to be less diversified and therefore carries more risks.
Okay, so investors with complex portfolios clearly can benefit from adding carbon market investments due to their diversification potential. Could you help us understand what investment options sophisticated customers might consider when exploring carbon markets?
Yes, so with carbon markets, there are different themes when it comes to carbon markets. What we've seen is timberland, blue carbon, and biochar projects are options that can offer the dual benefit of financial returns and environmental impact. Timberland or managed forest land provides steady use and inflation protection while generating carbon credits through forest preservation. Blue carbon includes initiatives such as restoring mangroves and seagrass, which store significantly more carbon than forests and adds additional benefits like coastal protection and biodiversity. And biochar projects lock carbon in soil for centuries, boosting soil health and enhancing agriculture productivity. While these options are gaining popularity among sustainability-focused investors looking to align wealth with purpose, they do come with their own sets of risks, and investors need to evaluate them carefully before investing.
Okay, so Lucy, Eugenia mentioned the risks. I guess the key thing is to dig into there. Everybody should be aware of any risks they're taking. So, what are the risks for carbon markets?
Thanks, Steve. So, completely agree. There's really nothing more important than looking at both sides of the equation. So, there are obviously a lot of opportunities, but also being aware of the risks and challenges that come with them is really, really key. So, carbon markets are a unique asset class. They're driven by factors such as emission caps, regulatory shifts, climate policies, etc. And these factors do not usually move traditional assets. The risks are just as unique for carbon markets, but not typical market forces. So, price volatility is really a key risk in project-based carbon markets, which is driven by unique factors. For instance, some reforestation projects have failed due to forest fires or land use changes, while sudden policy shifts have rendered certain credits invalid or less valuable due to additionality, which Eugenia mentioned earlier. There's often concerns around carbon credit quality and credibility, which can push prices down. But the main thing really, which is the lack of standardization. It makes it very hard for price discovery and market transparency, which can make the market difficult to scale. But there are a lot of initiatives at the moment going on to try and alleviate this problem and to really put some price transparency into the market. So ultimately, like most other assets, navigating carbon market risk requires tailored and proactive strategies.
Okay, and I guess one of the things that you can think of when thinking about risk is obviously managing that risk. Now, obviously, there are derivative markets for carbon, whether you're talking about futures or options. But maybe, Eugenia, for you, more intrigued to know what's the role of technology in risk mitigation and how it's redefining the landscape.
So, technology has been a game changer everywhere, including carbon markets. Blockchain, AI, IoT are tools that can help spot risks early, verify credit quality, and identify potential policy shifts. Digital platforms and blockchain are significantly enhancing transparency and traceability, reducing fraud and boosting investor confidence. Key innovations such as real-time tracking and automated verification are driving efficiency, scalability, and liquidity, making carbon markets increasingly accessible and reliable for investors. With technological advancements, carbon markets are well positioned to reach a new trajectory of transparency, impact, and scalability.
Okay, well, Lucy, Eugenia, thank you so much for joining and sharing your insights. It's clear that carbon markets can play an important role in a company's decarbonisation journey, and obviously there are meaningful ways for investors to be involved in this theme. However, it's important for investors to evaluate both the risks and considerations across the range of solutions available, and of course, align expectations from a risk, return, and impact perspective. With that, we'd like to thank everybody for joining us. We've come to the end of this episode. If you'd like to know more about carbon markets, please visit the link in the podcast description. In the meantime, I'd like to say thank you again for joining us, and I will speak to you again soon. Take care.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.